Good day, traders. Welcome to another interesting video. Candlestick pattern that matter. Candlestick pattern that matter. I want to do this course as a follow-up to my last training on time frame analysis. All right. I believe that there is no way you can grasp the lesson. You can perfectly understand the lesson on time frame analysis if you do not understand candlestick pattern. Okay, and I will also tell you in this training, I'm going to tell you in this training that you have more than 20 to 30 different types of candlestick pattern. But guys, in anything you learn in analysis of financial markets, you do not need to overcomplicate them. The moment you are overcomplicating a particular lesson or a particular subject area in analysis of financial markets, you are going to get more confused than you started. And of course, you know, when you become confused in analyzing financial markets, the end result is going to be disastrous. So I have learned over time to keep things simple, to remove everything that is not working and concentrate my effort on things that are working. Just as I told my Elliott with traders, my friends, you know, that putting all your efforts on trying to label Elliott wave chart will give you more disaster than a better result. So why not focus on the pattern? Why not focus on the waves, study their characteristics and their relationship? So the same thing we are going to apply to candlestick pattern that matter. Number one, I'm going to tell you the 4 different candlesticks that matter to me, especially when you are doing top-down analysis. Number 2, I'm going to tell you which time frame should you be looking at this pattern. Which time frame should you be looking at this pattern? And number 3, at what level of structure should you be looking at this time frame, at this candlestick pattern? Is it everywhere in the chart that it works? Is it that when you see it anywhere, it makes sense? No, it's not everywhere you see it that it matters. There are certain areas that you see it on the chart that it will make a lot of sense to you. These are the 3 things I'm going to be teaching you, and these are the 3 stuffs that are relevant. To what? To time frame analysis. So let's get started, guys. In case you don't know who is talking, my name is Nathaniel Tunde, a forex trader of great repute. You know, I combine fundamental and technical analysis. It has been working perfectly. All right. In our trading group, I always told them that I am right in terms of forecasting market direction 9 out of 10 times. If I'm wrong in any one, I'll reassess it and check it again. But really, do I go wrong? Why? I've learned and mastered how to apply Elliott wave theory. So if you want to learn more about market forecasting using Elliott wave theory, you know, go to my channel. You see a lot of Elliott wave theory course there. I've simplified it to a level where every newbies, every new beginners in forex trading will understand perfectly. But then today, let's get started on a candlestick pattern that matter. Remember, subscribe to the channel. Remember to subscribe. It's very important. And if you subscribe and you don't press the notification bell, you may not be receiving notification for my new videos. And I promise you guys, I'm going to be giving you only content that will improve your trading. Only content that I know will be very vital. I have removed every trash, every trash that, is not relevant to your success. I have deleted them from my brain. Those ones that I know when you study and master very well will aggravate, your development. Those are the stuffs I bring for you in this channel. You're not going to see any video that is a trash. It's not going to be possible, okay? So, what are those 4 candlestick patterns, guys, that are important to me? Remember, we have countless number of candlestick patterns that people bring on board every day. Maybe, maybe not, they are useful for them. But as far as I'm concerned, and right here, guys, I'm talking to my followers, I'm talking to my subscribers. Concentrate on the few ones that will give you results. Do not concentrate your effort on those other candlestick patterns that you will be guessing. These ones I'm giving you, you don't need to guess them. Even somebody that does not go to school will see them and identify them anytime, any day. All right. So the first type of candlestick pattern that I want you to take note of is this first one, and it has to do with bearish one. This is what is called bearish engulfing. Okay, bearish engulfing pattern. Bearish engulfing pattern. Okay, bearish engulfing. Engulfing. All right, bearish engulfing pattern. Okay, take note of it. Do you see this green one? It means in an uptrend. Can you see in an uptrend, the last bullish candle appear when the trend want to reverse and a sell pressure came. Can you see the sell pressure? You see the red candle totally engulf the green candle. And this pattern will happen when you get to the resistance. When you get to the resistance, okay, you get to the resistance and the market is about to fall. That is where you see this candle stick pattern. It is called bearish engulfing. Remember, when you are coming from a downtrend, you are coming to supply area. When you get here, you see the last green candle. After that last green candle, you now see this red candle appear. That shows, and that this red candle, the body of this red candle totally cover up the body of this, of this green bullish candle. That's bearish engulfing. And one thing that is very significant in this bearish engulfing candle is if this one lifts a wicks here, guys, if it lifts a wicks here, it means that the likelihood of this wicks to have grabbed liquidity here is there. Okay, it has grabbed liquidity here, and then you have this selling pressure straight off. Okay, I'll be showing you example later. What I've just told you is this one, guys. Okay, can you see? I don't want us to jump the gun. We're coming there. Okay, so this is what is called bearish engulfing. Then there is this one that I also use. I use this one very well. It is called railroad track or railway track. Anyhow you want to call it. The idea behind the name given to this is that it looks like a railway track. Railway track, you see, it's always in two. All right, it's always in two. Can you see what is important? It's not the name, guys. It's not the name. It is the appearance and the characteristics and where to find them. That's what is important. Don't focus on name. Focus on name. You may not know the name, but when you know the characteristic and the appearance, once you know it and you can apply it on your chart, you make money. So whether you know the name or you don't know the name, we don't want to know. what is important is that you receive the dollar. Is that okay? So this railway track or railroad track, can you see two big red candles of equal size standing together, guys? Can you see standing together? When you see this, you don't see this as support. You don't see this in the middle of the chart. You see this, you know, at the top of the chart at supply area. This is where you see this. And I always love a situation where the first one of these leaves a week. You know, I always told you this weeks here will be a confirmation of liquidity grab. Okay, to be a confirmation of liquidity grab. Okay, and you now see this one does not leave a weeks to the upside. The essence of this weeks is that there was formerly a buy to that upside, and after that buy, the market flush. So that buy you see is a grab of liquidity at supply, all right, and the market flush. Okay, and after the market flush, the next candle that formed before it does not leave a wick. What do you mean by a wick, guy? Let me show you what is called a wick, in case somebody does not know. Do you see this? Do you see this? You see the body of candle here, and you see this one that is the tail that's left behind. This tail that is left behind is called a wick. And how is it formed? It's formed because there was formerly a sell-off to this level. And after that, there was a big order here where the market peaked. The candle picked that order. And as soon as it picked a buy order, it flushed to the upside and leave a trace behind to show us that there was formerly a sell pressure at that area. But that sell pressure was immediately consumed by a big buy order that exceeded the sell pressure. That is a case where you have excess demand over supply at this price. Okay, and as soon as market got to that price, because there was excess demand for gold at this level, there was excess demand that, you know, that exceeded supply of gold. What happened to price? Price will go up. Boom. That's why you see that immediately price got to this level, boom, to the upside, and it left a trace. That trace is what is called wick. The same thing I'm telling you. I love to see a railroad track where the first one, nobody might tell you this, but based on experience, you know, and observation over time, you know, and adding the concept of liquidity to candlestick pattern, understand why the first week of a railroad track, the first candle of a railroad track always leave a wick, a big wick. And when it happens like that, but the body of the first railroad track with the second one now is the same, but the first one leaving a wick, that wick is, you know, an indication of a grab of liquidity. And in that case, when you put your stop loss above that wick, the market will never visit that place. The market will do what? Will never visit that place. Why? Because there was a grab of liquidity and there was no incentive for the market to go back to visit that area, visit that level. So many of you guys, you have seen this before, but the behavior and the characteristics are not well linked. Okay, and by the time I'm done with this training, you'll be able to effectively link all this knowledge I'm giving to you with time frame analysis, and that is where it begins to make sense. Is that okay, guys? So this is bearish reversal pattern, because this happens at the top of the chart at resistance. Okay, so let's just take the opposite of the bearish pattern and look at the bullish pattern, guys. This is bullish engulfing. Bullish engulfing. Remember, I'm discussing with you candlestick pattern that matter. Bullish engulfing. Don't go and carry engulfing. Don't go and carry Bible stick Bible and begin to study, guys. When you are studying all those ones, many of your friends are studying only these four and they are making money off the market. You are still studying Bible stick pattern. There are a lot of things to study, guys. You can't read everything. You can't study everything. Study the one that is important for you and make your money and go and get out. Do you understand, guys? Don't go and disturb your brain. Some of us have made a mistake before, but we are in a position to correct you now. All right? We are in a position to correct you. It is not everything you can apply. By the time you sit down to want to apply everything, you will confuse yourself. You'll be a confused person. And a confused person don't make money in financial markets. I believe you know that. A confused president will not be able to lead the country well. A confused central bank governor, will lead the economy to peril. A confused minister of defense or finance secretary, as some countries call it, will lead his country to disaster. You don't need any element of confusion in financial market analysis. You need brevity, you need preciseness in analysis, you need to apply every available tools for you to get precise in whatever you are doing. That's what I'm telling you. So precision does not mean that you must gather all the book together to get a precision. No. Get the one that works. Know how to relate it with other body of knowledge and arrive at a conclusion that is going to be useful to your analysis. That's it, guys. So, can you see? There was downtrend rather. The market was making a downtrend. This candle appeared, and all of a sudden, another candle appeared like this. Can you see? And this bullish candle, this one is bullish. This bullish candle appear here, totally cover up this red candle that is here. When that one happens at support, at demand, we know that, oh, this is the end of the downtrend. And what are we looking at now? Boom. We are looking for boom to the upside. We are looking for the boom to the upside. That is what you see here, guys. This is what is called bullish engulfing candlestick pattern. Do you understand now? Good. The last but not the least that I consider, and I'm going to relate to time frame analysis for you to make sense, is what is called bullish railroad track. This is bearish railroad track because it's formed at a resistance where the market is expected to move to the downside. Okay, then this one is formed at a support or at a demand area where the market is expected to move to the upside. But then, guys, I told you I love to see the first one appearing with a wick. Guys. I want to put a wick for you. Just know that this is a wick. Okay, just know this is a wick. It's not at the middle, but just manage this, guys. This is a wick. I love to see the first one of a railroad track coming with a wick. If I see this come with a wick, I'm always very happy because that wick is a, is a sign that it has grabbed liquidity. Because when people are buying from here, guys, where do they put stop loss? Here. And when the market has come here, grab this area, pull back immediately, what it suggests to me is that it has come to pick all their orders, all their stop losses. It has consumed them as liquidity. Boom. And as soon as it consumes them, of course, when you are buying, guys, if you put your stop loss here means sell. That's what it means. You are buying. The stop loss is a sell order. So when market makers come and come down to pick yourself, to pick your stop loss, as soon as your stop loss is picked, then sell order, buy order, then you have increased, you have given them a sell order for their buy. They want to buy, but you have put stop loss for your buy here. So when they catch your buy, it means you are selling, they are buying from you. It means you are a seller. because you have put your stop loss here, and your stop loss order is a sell order. So it means that they are using you. That's why we call it liquidity. When you hear us say liquidity, they want to buy, but for them to buy, they need somebody who is selling, guys. They need guys who are selling. And because you have put your, you are buying too, but you have put your stop loss here, when they come to tap your stop loss become a sell order for them. It means that you are selling for them. They are happy. And then they are buying from you. And all of a sudden, the market will make a boom to the upside. Do you understand now? That is the concept of liquidity. You can see equal low liquidity. Market grab it. So when the first candle of a railroad track leaves a wick behind, we are very happy to see that. Okay? And then the second one now have a body that's equivalent to this one. That is cool for us. It means upside is guaranteed. Do you understand now? These are the 4 candlestick patterns that matter to me. Remember, there are many types of candlestick pattern, but the one that is useful for me, the one that enables me to make my money with ease, is the one I focus my attention on. I don't want to care about the formation of other candlestick patterns. I don't want to expend my energy unnecessarily learning different types of things that's going to complicate my analysis. I'm interested in what I will focus on, and when I see that one alone, I know that money is going to come. All right? So right now, guys, this is just the part 1 of the video. I want us to go to part 2 of the video. How do we relate candlestick pattern to time frame analysis and benefit immensely from it in our trading? How do we relate it? Remember, if you have not watched my video on time frame analysis, you have to go back. Go and watch time frame analysis before you come back to candlestick pattern. Otherwise, this course is not going to make sense to you. Right? So let's illustrate this with this example. All right. So for instance, of course, you know that some of these lessons are sequential. First, you must know structure. 2, you must know how to apply Fibonacci. 3, you must know, you must know a little bit of Elliott wave theory. All right. So by the time you know all this, and you are now getting to understand structure, you are getting to understand time frame analysis, and then you are building it up with candlestick pattern. My friend, you will be great in chart analysis. So let me apply some of these candlestick pattern that we have learned. Let me apply it. So the part 2 of this training is what level. I've told you the type of candlestick pattern and their appearance and their characteristics. The second part now is where in the chart are you expected to see this pattern? Is it everywhere you see it that it matters? No. All right? No. When you are doing your analysis, guys, remember I told you that when a market is rising, you are using daily time frame for your analysis, okay, for your direction. Remember, we discuss it in time frame analysis. You can use daily, weekly, and monthly. For your direction, 4 hours, 1 hour, 30 minutes, 15 minutes for your entry, depending on the type of trader you are. Are you a swing trader? Are you a day trader? Are you a scalper? A scalper can even use 30 minutes for his direction and use 1 minute, 3 minutes, 5 minutes for his entry. That's a scalper for you. So Now, let's look at this. Okay. Now, if this market has made a three-wave move down, that is a correction. Okay. And after it makes an impulse, you are expecting a corrective structure. Where is this corrective structure supposed to stop, guys? Take your fib from here, this level to this level. So you can see that this market right here, guys, is at 50 to 61.8. But are you supposed to just click a buy at 50 to 61.8? This is the middle here. This is where you want this retracement to come. Remember the rule, confirmation, the rules of confirmation of entry. Number one, you see an impulse. Number two, you are able to define the correction. All right, 1, 2, and 3. To the downside, we have defined it. This is a zigzag corrective structure. And you know, zigzag corrective structure is a sharp correction. All right, and that is number two. Number one is you must see an impulse. Number two, you must be able to define the correction. Number three, the correction must hit 50 to 61.8. And if it's a zigzag, it can hit 78% retracement. And then number four, if you check left, if it is a buy, you must see, you know, a demand level. You must see a demand level. So you see a big candle right here, real quick, guys. See it? That's a demand level. I'm now adding another confirmation to you guys. Another confirmation is what I'm adding to you here, real quick, guys. You will see an engulfing candle. Remember, this is a daily. This is a daily time frame, guys. This is a daily time frame. You want to see an engulfing candlestick pattern at the end of correction. This will signal to you that corrective structure is over. This is a daily time frame. This is not your entry time frame, guys. This is not your entry time frame. This is a daily. So you have seen this in a daily. What type of candlestick pattern is this, guy? This is a bullish engulfing. This is it here, guys. This one, bullish engulfing. This is the pattern that will appear at the end of correction at the fib level of 61.8. And as soon as this one appears on a daily time frame, this is not for you to get in, except you are ready to have a big stop loss, putting stop loss at 1720, where the market is at 1756. You can't research a big stop loss. Okay, so this is step one. You have seen an indication that yes, correction is over. You are now moving to the upside. So what do you do next, guys? What you do next is you now go to your entry time frame. Remember, we need to do this. Let's put a vertical line here real quick, guys, on this one. Boom. That is our daily signal, where we see bullish engulfing at the end of 61.8. So let's go to 1 hour, guys. 1 hour. Let's go back to that place. Let's go back to that place. Can you see? So now, you now see that you have the impulse. Look at the impulse on 1 hour. You have the impulse here. So this impulsive move here has to be corrected for you to have a good entry. Can you see that daily? That daily was ending here. We don't want to get in here, guys. You now take a fib of the smaller time frame, fib the impulse, you know, and get a retracement level to 50 to 61.8. And here you see it there, guys. Boom. That is your trade to the upside. Can you see? Time frame analysis related to what? To where? To what? Related to candlestick pattern and fib application. And here you have it, guys. Can you see? So where do you put your stop loss? I put my stop loss just below 78% retracement of the impulse. If it goes below the 78% retracement of the impulse, I'm not going to be interested. Can you see, guys? That's how you do it. And your target is going to be based on the what? The higher time frame pattern. When you want to spot your target, go to daily again. Okay, go to daily again and look at the structure. The structure tells you you are going up here. This is your target. Can you see? But where is your entry, guys? See your entry. Entry based on 1 hour, stop loss based on 1 hour, but target based on daily. Can you see how I've done it now? Let's go and check another type of candlestick pattern. Okay, this one is very, very clear. Let's clear the fib. Let's clear the fib. Let's clear this one. This is how you do it. Another example that I'm going to show you here real quick, guys, is engulfing, bearish engulfing. Can you see? It looks like a railroad track, Can you see? But you see, this railroad track, this is a railroad track, but you see that this one is of the same size with this one. The psychology behind the formation of this pattern is that there was, a bullish pressure at resistance or supply area of the chart. But immediately, that buy pressure was consumed by a bigger sell order. When you see that a bigger sell order, all right, so what you do is that at this stage, at the formation of these two candlesticks, on a daily time frame, you know that the buy is over. Now you want to get ready for a sell. And what you do in order to catch this sell is you just do this, and you now go to smaller time frame. That's your entry time frame. Okay, go to your entry time frame, guys. And what you just do is you look for the impulse on 1 hour time frame there. Look for the impulse, guys. And where is the impulse? See the impulse at this level, guys. See the impulse here. When you see that pattern there, you must see appearance of an impulse, guys. Can you see this impulse? Remember, your impulse ended here and not here. Why? Because of the concept of orthodox bottom. All right, that's what is called orthodox bottom. Most of you are making the mistake of having to fib correction as part of your impulsive move, and that is why you are not getting the exact fib level where you should get in. Do you understand now? So now, what you are going to see here, guys, is this impulse. You're going to fib this impulse on this 1 hour, your entry time frame. If you fib it, you can see now that you are having a 38% retracement, which is acceptable for a regular flat. 1, 2, and 3. It is acceptable for a regular flat. So you can get in for a sell here, guys. Get in for a sell here. Put your stop loss where just above 78. All right, and then boom, look at daily to go and get your target. Can you see how we have applied this candlestick pattern and making use of the variation in time frame, making use of a bigger time frame for the direction? You don't spot, you are not supposed to spot this candlestick pattern on your entry time frame. No, I am interested in seeing this candlestick pattern on my direction time frame at the end of its structure, whether at the top or at the bottom, or at the fib retracement level of 50 to 61.8. If I spot it there, I want to see the generation of an impulsive move on a lower time frame. And that is the impulsive move on a lower time frame that I'm going to fib to get my entry. And you don't do it this way and be wrong all the time. You have to be right. 80% of the time. So do you understand it now, guys? So that's how you get this one. So let's move on. Let's move on. Let's go to daily. Let's go and spot the candlestick pattern at a structural area. We want to spot it at a structural area. If it doesn't come at a structural area, you don't get it. So look at this impulse on a daily. This is an impulse. Boom. It's an impulse. For us to get in, we want to see a retracement of this impulse. You know the rule. When you say an impulse, first thing is an impulse. Second thing is a retracement to 50 to 60. Sorry. Let me not jump it. Let me not jump the rule for you. First rule is to see an impulse. Second rule is to see a defined correction. Third rule is to ensure that the correction has hit 50 to 61.8. And if it's a zigzag corrective structure, let it hit 78% retracement because it's a sharp one. And the third rule is to do what? Is to get in for your entry. So now, look at this. We have Fibit, where is from here, from this level here to this level here. And 50 to 61.8, guys, is exactly here. Boom. So let's remove the fib. And then what are you expected to see on your direction time frame? You are expected to see a candlestick pattern on that direction time frame at the end of the corrective structure. That candlestick pattern will tell you you are now ready for a move to the downside. And what's the candlestick pattern that we see here, guys? We have seen a bearish engulfing candlestick pattern. Where is it? Boom, here. Can you see? Where is the bearish engulfing candlestick pattern, guys? Look at it here. Here. Can you see? And I told you something that was very critical when I was discussing candlestick pattern with you from the introduction, that when I spot a bearish candlestick pattern, I want to see that the green is having a wick on the top and the bearish candle is not having anything on the top. That is the best to me. And I told you the interpretation of this is that the bullish candle that is carrying a wick has tapped liquidity from supply, and it will never return to the top of that wick. It will never return there. Okay, so this is daily. This is daily here. Can you see this candle? Can you see green followed by what? Red. Are we just spotting this at any level? No, we are spotting it at 50 to 61.8% retracement of the daily impulse. Do you get? So what we do is simple. This candle, put a vertical line on it. Okay, we are done with this. Let's clean it. So now what we have to do is to go to 1 hour, which is your entry. Go back there, go back there, go back there. Now, oh, sorry. Let's come back. Go back there, go back there, go back there, go back there. Give us, load. Ah, it has loaded. Yeah. Go back to 1 hour, guys. 1 hour, 1 hour, 1 hour. So what did I say? You should spot under this 1 hour time frame. This is crazy, guys. These are things you need to know. These are things you need to know, guys. I said spot the impulse on the 1 hour. Impulse does not start from here, guys, because after this impulsive move, there was a correction. So we are not concerned with that. We want to be concerned with this impulsive leg to the downside. What do I say you should spot? You should spot 50 to 61.8. But if that structure is a regular flat, guys, 38% retracement is okay. Go and watch my video on corrective structure. I made it clear as a rule, as a guideline, under formation of a flat corrective structure, that a regular flat is a sideways corrective structure, and therefore it is permitted to end at 38% retracement. It's always a shallow corrective structure. It's a sideways. It's slipping. It's lying on the sideways. It's not going up and down. Therefore, it is permitted to end at 38% retracement. So when you see this forming a regular flat, you know that the corrective structure is over here. Where do you put your stop loss, guys? Boom. Sell here, put your stop loss just above 78. In case there is transformation of structure, you are not expecting this structure to get to 78% retracement, and then boom to the downside. Can you see? I'm backtesting candlestick pattern, concept of liquidity, time frame analysis, joining everything together to give you trade setup using application of Fib. I don't want to get it complicated. If not, I introduce divergence into it as a further confirmation to you guys. When you get these details, you don't need to be running to any other place to go and learn, or to go and pay people, big money to learn financial market analysis. No, don't do that. Some of us have made this sacrifice. We have made this a lot of payment to learn, and we have practiced, we have observed, we have done all the big work for you. You're only left to just come and implement and make money. All right, let's go on, guys. Let's look for another thing. Okay, so somebody will say, oh, the market that is already happening, that is the one you are analyzing. Give us the one that have not happened. Give us the one that have not happened and what to expect. Give us the one that have not happened and what to expect. I will show you now, so that you know that you know what you are doing. If it is based on theory, you have nothing to fear. This is how to approach trading with confidence, because what you are doing is not based on just your own, just your own will, or just your own wish. You are not wishing. It's not a, an issue of wish. You are applying theories. You are applying universally acceptable concepts for trading financial markets. In as much as you are in line with the concept and the theories that govern proper trading culture, you approach your trading with confidence and you expect a good result. Now, let's go. Let's take this. I've gotten it. Let's look at this impulse. Let's move to the downside. Where are we expecting the correction to hit, guys? The laws say, the rules that govern, my entry strategy says, when I see an impulse, I want to see a correction to where? To 50 to 61.8. That's number one. Number two, I want to be able to define the correction that gets to that area. And right now, real quick, guys, I'm already trying to what? To figure out this impulse, this correction, this another impulse to get here. Oops, wait. Watch out. This is an impulse, A, B, and C. And by the time C get to this level, what happened? This will have been a complete corrective structure. Guys, what am I looking for at this level of corrective structure? When the corrective structure is over here, what are we supposed to look for? We are supposed to look for a bearish pattern on a daily time frame. We're expected to look at something that look like this, guys. This one. Boom. We're expected to look for something like this, or something like I want to look for a railroad track. Okay, just let's come. This guy, let's see if you can copy it. Where is goes feed from here to here. Let me see if I can copy it. Oh, no, I can't copy. Just leave that. It's too small. Okay, this pattern, I'm expecting it to come over here. And when it comes to this place, what are you supposed to do, guys? Let's assume that this pattern right here, real quick, is here. So what are we supposed to do? We just look for a horizontal ray, put it on the daily, go back to 1 hour, look for the impulse on 1 hour, look for the correction of the 1 hour to 50 to 61.8. If it is zigzag corrective structure like this, make sure it gets to 78. If it is zigzag like this, let it get to 78. If it is a flat corrective structure, let it get to 38 to what? To 50% retracement. That will be enough, because it's sideways corrective structure, and you let it go, boom, to the downside. If it is zigzag, you let it go from 78, boom, to the downside. But I tell you, in most of the cases, based on experience, it doesn't go beyond 50 to 61.8. Do you understand? That is what you are expected to be doing, guys. These are added confirmation to the structure. Okay, and then let me now show you something, guys. Can you see that here you have an impulse, you have a correction, you have an impulse, you're expecting a correction, you have an impulse. Okay, now on the daily time frame, where you are expecting your signal, on the daily time frame where you are expecting your signal, there is one other thing you need to look forward to in order to confirm to you that you are going to have a massive sell to the downside. And if that is not appearing, you don't have to risk too much money on the market. Look at here. At times, RSI, stochastic will give you better information than RSI. Look at it here. Look at it here. Look at it here. Look at it here. What do you notice, guys? What do you notice? What we notice here on the chart is that the market is forming a lower low. Can you see it's forming a lower low? A lower high rather, sorry, it's forming a lower high. This high is higher than this one. But as this market is coming and it's stopping 50 to 61.8, it's forming a lower high. And as it's forming a lower high here, what do you expect? You also expect this indicator here to form a lower high. But you refuse. This high is supposed to be lower than this one, because here is lower than this portion is lower than this portion. So this portion is supposed to be lower than this portion, but rather is higher than this portion. It's higher. So this is what is called a hidden bearish divergence. Hidden bearish divergence. So when you spot, after you have spotted your candlestick pattern, you have spotted the selling pressure, you have done everything, come to the RSI or stochastic, and when you spot a hidden bearish divergence, that is a confirmation of the existence of continuation move to the downside. Go and watch my video on divergence trading strategy. You are going to see the detailed analysis of hidden bearish divergence. So as soon as we have a bearish divergence here, look at the indicator, look at the RSI, relative strength index, that shows the strength of the move either to the upside or to the downside. This time around, the move to the downside is below 50, showing you that the move to the downside is non-negotiable, because there is a strength to the downside, is bearish. That's why the strength of the indicator is below 50. If it's above 50, the strength is bullish. It's bullish. But if it's below 50, it's bearish. So right now, RSI is below 50, and stochastic is telling us that we have a better sell opportunity, that the market, even though the market is making a lower high, but that lower high is a better area to sell, because the indicator has pushed up to give us a premium price, that this is a price that you should sell, that this price is better to sell here than here. because the push that is going to we are going to realize to the downside if we sell from this area is going to be greater than the one we realize from this area. That is why the stochastic is more of the upside at this level than here. That is the interpretation of bearish hidden divergence. Guys, that is the same thing we are expecting here, guys. We're expecting this market to come boom, boom, and boom to the upside here. And by the time it got here, look at the level here, look at this area, look at this level here, is making a lower high. We expect this one to make a higher high so that this guy will move from here to here. Can you see? By the time it's making a higher high here, this guy here from this level to this level, it's making a lower high. And then when we see a railroad track, a bearish railroad track here, or we see an engulfing, bearish engulfing here on the daily time frame. And we are seeing this confirmation here on the indicator, and the RSI is showing bearish. That is, we are going down. What you have to do is to go back, step down to your entry time frame. If it is 15 minutes, if it is a 1 hour, go back to 1 hour. Identify an impulsive move in the direction of forecast. So when you get that bearish move in the direction of forecast, just take a fib there. If it is irregular flat, ensure that you enter your trade at 38% retracement. If it is other type of flat, it can come to 50 to 61.8. If it is a zigzag corrective structure, it can come to 78% retracement. Once you get that here, guys, go into your trade with confidence. Go into your trade with confidence. Remember, guys, before you even do all these things at all, you must have done what we call background analysis. Background analysis. You go to fundamental. Go and check the fundamental. What is happening about this pair? If it is GBP, JPY, what is happening about GBP? What's happening about JPY? What is the fundamental that is controlling GBP? What's the one that is controlling JPY? Just oppose them together. If you follow my analysis of fundamental, okay, fundamental analysis, you follow it very well, you will know how to know which one to buy, which one to sell, using interest rate differential, using, economic performance, by considering key indicators like trade balance. That's what is called balance of trade. That's what is called current account. That's what is called inflation rate. What is the inflation rate? Okay, if they increase interest rate, it doesn't mean that you just go and dogmatically buy the currency. You need to ask yourself, is this increase in interest rate, is it that to arrest inflation, is it caused by GDP? Is it caused by growth, or is it caused by imported inflation, like increase in supply gap of energy and all those things? So those are the things you should do. Once you are done with that and you go to the technical, this is how you do your technical, and you do it perfectly without going wrong. Are you okay, guys? So that is how you will marry your fundamental analysis with technical analysis. Then you now come identify the 4 candlestick pattern that matter to me, and then where are you supposed to see it? You're supposed to see it at the bottom of the chart, or at the top of the chart at resistance, or at the expected fib level, 50 to 61.8. When you see it, what time frame are you supposed to be looking at your candlestick pattern? Many retail traders are making this blunder. And when I see them doing this, I want to cry within me, because this is lack of knowledge. You are not expected to be looking at candlestick pattern at your entry time frame. Candlestick pattern is almost useless at your entry time frame. Where you are supposed to be looking at candlestick pattern is your direction time frame, because it's signaling to you that there is already a pressure to either buy or sell. And so when you see it at the top or at your fib level, where you are expecting a continuation move, as soon as you see this candlestick pattern, and you look left, you see a supply area. Oh, beautiful. Like, look at this one, guys. At this level, you see a supply area. Look at the big candle here. So as soon as you see that, just go to your smaller time frame, your entry time frame. What you are required to see there is that you should see what is called originating impulse. Let the impulse come on smaller time frame and let it be corrected to 50 to 61.8 or 78% if it is a zigzag or 38% if it is a regular flat. As soon as you see that, guys, don't hesitate. Just get it. Get it. An additional confirmation I've given you is that this hidden divergence, hidden bearish divergence, or bearish hidden divergence or bullish hidden divergence, check it at higher time frame where you are spotting your structure. Once you spot it there, forget it. Look for your candlestick pattern, step it down to lower time frame, look for impulse and correction, get into your trade, and you will be right 70 to 80% of the time. Are you okay now, guys? So if you enjoy what I do, you enjoy this content very well without missing word, and you see that it's raw, I'm teaching you raw, and many more are still in my brain to teach you that I apply. Just subscribe to this channel if you have not done so. If you have done so, fine. Comment, let me see your comment. If you get it, let me see it. If you don't get it, you want me to repeat it, let me know. I will do part 2. Just because of you, I will do what? Part 2 of this training. All right? So share the video, like it. Many of you just watch, you don't like. If you watch it and you like it, it doesn't take anything from you. Just go to the like it. It is because of your like that YouTube will spread this video to other people to watch. And by doing that, it's benefiting more people. All right? So thank you for watching, guys. I see you next time with another interesting video. Thank you. God bless. Peace.